Ever wondered why some miners thrive while others struggle when prices fluctuate? The secret lies in a single metric that defines your hardware efficiency. Today we dive deep into how joules per terahash dictates your monthly profit and why it is the most important number in your whole mining operation today. Let us start by defining what JTH actually means. It measures how much electrical energy a machine consumes to produce 1 terahash of computing power. Think of it like miles per gallon for a car. The lower the number, the less energy you use for the same result, which impacts your bottom line every single day. High-end miners like the Antminer S21 show efficiency ratings below 20 joules per terahash. This represents a massive leap forward for the whole industry. Contrast this with older models running at 60 joules per terahash. These machines consume triple the power for the exact same amount of total work performed. This brings us to electricity costs, which are the largest ongoing expense for any miner. Small efficiency shifts lead to huge gaps in operating costs over time. If your electricity price is 10 cents per kilowatt hour, a machine with poor efficiency might spend 90% of its revenue just on monthly power bills. A highly efficient miner at that same electricity rate might only spend 30% of its revenue on power, leaving a much larger profit margin for you. To calculate your net income, you must subtract power costs from your gross rewards. Efficiency is the ultimate factor for long-term sustainability in mining. As the network difficulty increases, older machines eventually reach a point where they cost more to run than they earn in digital currency rewards every day. This is known as the shutdown price. Machines with lower JTH ratings have a much lower shutdown price, meaning they can stay online much longer than others. During market downturns, efficient miners keep stacking coins while others are forced to unplug their hardware to avoid losing money every single day. You must also consider the initial capital expenditure. More efficient machines cost more upfront, which impacts how long it takes to break even on the unit. A cheap, less efficient machine might look attractive, but it can quickly become a liability if energy prices rise or a reward halving occurs unexpectedly. After a halving event, the income per terahash is cut in half. Only the most efficient hardware can maintain a healthy monthly profit after that happens. When choosing hardware, you should calculate the total cost of ownership over 3 years. This includes the price plus the total estimated power bill costs. Often paying a premium for a 17 JTH machine pays for itself within 18 months compared to a 30 JTH machine in the same time period. This math is essential for anyone looking to scale their operation. Scale increases the impact of every joule saved across many hundreds of individual units. Let us look at a scenario. If you have a 100 terahash machine at 35 JTH, it uses 3.5 kilowatts of power continuously every hour. Replace that with a 100 terahash machine at 20 JTH and you save 1.5 kilowatts every hour. That is over 1,000 kilowatts monthly, depending on your rates. That could be over $100 in extra profit per machine every month without changing anything else in your mining setup. This is why professional data centers prioritize efficiency over raw hash rate. They know reliability and low power usage lead to better returns for them. Another factor to consider is heat management. More efficient machines generate less waste heat for the work, reducing your overall cooling requirements. Less heat means your fans do not work as hard, which saves even more power and reduces the wear and tear on your expensive hardware components over time. It also means you can pack more machines into the same space without overheating, allowing you to maximize your physical infrastructure density and output. As the industry matures, we see manufacturers push the limits of physics to reach even lower efficiency numbers like 15 joules per terahash today. Staying ahead of this curve is vital. If you run gear from 5 years ago, you are likely losing money unless you have nearly free electricity at your site. Always check the specifications before purchasing. Do not just look at the terahash number. Look at the watts and calculate the JTH yourself every time. Take the total watts consumed and divide it by the total terahash produced. That calculation tells you the true economic value of the equipment you buy. Understanding this relationship separates the hobbyists from the professional miners who stay profitable through bull and bear markets alike every year. If you are planning to enter the mining space, focus on your cost per kilowatt hour and hardware efficiency first before looking at anything else today. These two variables will define your success more than the price of the coin. Efficiency is the ultimate protection against market volatility long term. The landscape of digital currency mining is always changing, but the laws of physics and economics remain constant for every participant in the network. By prioritizing joules per terahash, you ensure that your investment remains a productive asset rather than an expensive piece of electronic recycling. Take the time to run these numbers before you spend a single dollar on new equipment. To ensure your mining operation is built for long-term success, we hope this breakdown helps you make more informed decisions for your mining journey. Choosing right hardware is a critical step in your financial plan. Thanks for watching this educational guide. If you found this useful, please consider subscribing for more deep dives into mining profitability and tech.